Hi everyone. Today we're having a look at Flow.Life. Why is Flow.Life interesting? Andreessen Horowitz, the VC, just gave Adam Neumann, the founder and disgrace founder of WeWork, $350 million for a new startup that has not actually started operations yet. There's a little bit about the startup at this link on Andreessen Horowitz A16Z investing in Flow. But there's precious little. So I'm going to be a little bit speculative today, talking about what Flow is, what is the problem that they're really trying to work with. So let's get the pencil out. So basically, the problem that you've got is that most people buy the houses, and that's hugely expensive. Other people rent houses, and then you end up with no assets. They each have different pros and cons. And what basically Adam Neumann is thinking is there a middle ground? Is there a way of transforming the way that we procure, we buy, we construct, we build, we live in, we use, we sell, we rent, we own residential property? So he's got a bit of a track record. He's done it a couple of times before. One time before with WeWork, he created a unicorn. Yesterday's check makes him a unicorn in another startup. So what are we trying to do? So we know nothing. So this is hugely speculative, but he's got a persona. It's meant to be very tech enabled. It's meant to be aimed at people presumably struggling a little bit with the cost of living crisis. And the housing, probably relatively young, tech-enabled people, very much the people who went into the co-working spaces to start with. So we've got a sort of persona over there. Let's call him her sort of 20 to 35 techie. And by the sounds of it, they really want the community. They want somewhere to live, but they want to be building an asset at the same time. So the value proposition is going to be very much something along the lines of, okay, how do we create value so that this guy has got a property that is going to be increasing in value over time, so they own part of an asset, so it's going up, but at the same time they are part of a community with lots of other people, where other techie kind of people or other cultural kind of people, think of communes, maybe something like a kibbutz, are managing to get the benefits of that. So you're saving money, not by living one by yourself. One person in a house is hugely expensive. Two people is only something like 30 or 40% more than one person cost wise. You get a lot of people together, you can bring down the cost of living radically, but at the same time it's got to be quite different from being a student accommodation, which is okay, but it's a bit meh once you become a professional and got your salary. So that's what the value proposition is going to look like. And remember, guys, I don't do a lot of preparation for this, so this is how it's working. This is how it works in real life when you're working with me on a business model canvas and putting it together. So let's think. Okay, let's bring out the business model canvas here. So we've got always 1, 2, 3, 4. Okay, over here we've got customers. Down here we've got cash. Here we've got the value proposition. Over this left hand side we've got the key resources, what you need to do to create the value proposition. Over this side it's what you've got to do to sort of deliver it to the customers, deliver the value proposition. So over here, that makes it desirable, that makes it feasible, this makes it viable. So let's just get rid of those things. So how are we going to get this to work? So let's say we call them young pros, and living in an asset. Oops, let me see if I can just living in an asset community, right? Okay, so you're living in a community which drives down the cost of owning the asset, but it is actually an asset. So as the asset increases in value, as the community increases in value, just like a house price, you should be able to get something along there. Now, I think this kind of business model, it's really not going up and going to be going out and buying an awful lot of flats, etc. Because that's essentially just a buy to rent business model. It's nothing particularly new. Andreessen Horowitz wouldn't be putting 350 million into that. They could go into a sort of real estate venture, and they'd be getting whatever a right gave them. Equally, it's not going to be particularly a marketing or sales driven or organization. It's because they've got to be doing something fundamentally different. So the business model is going to involve creating some kind of assets, and we know that Adam Neumann tried a number of years back with We Live to buy some buildings and convert them. What I think they're likely to be doing is they're going to be building some sort of communities, and that would explain the $350 million price tag. That's an awful lot of money for software, especially when you haven't got something. So it's got to be something physical. So they're either building, making buildings, or converting them and making them tech enabled. And so we're going to be having a key partner here, because we know that Adam Neumann has got no, so let's put these in here, buildings, and we've got some sort of developer. Now, we know Adam Neumann's got no particular knowledge or experience about building. He's not a construction engineer. He hasn't been going out and been doing building development. But you can hire some people. So what I'm thinking is, at the moment, the typical business model is very much developer acquires lands, gets planning permission, builds buildings, so, and then sells them on to people, and that's their business model. So what happens if we start vertically integrating the Flow business model and say, okay, so the developer builds and owns, and then there's some sort of transfer of assets to the community. I'm not sure if that's right, but that seems to be one potential way that it's going. An example would be looking at the railways. Traditionally, the railways built a railway line, then they built a town around the railway line, and they didn't make any money on the railway line. They made money selling off the property surrounding the railway line. And a good example is the MRT in Singapore, the Mass Rapid Transit rail company in Hong Kong actually is much more of a shopping mall company, which has trains to bring people to its shopping malls, rather than a railway company that also owns shopping malls. So that, I think, is going to be the core of it. Obviously, they've got big costs for developing it. There's going to be some rent, hire, purchase agreement, so you're going to pay for living in there. And then there's also going to be a big chunk of tech development, and so I think there's going to be some clever reimagining of, okay, how would a community of people think back to a traditional village of 150 people, is it Dunbar number or Durham number? Dunbar number. Have a building with a community of 150 people, about the number of people you could really live and keep track with. How would you make a really tech enabled building so that they could all live together? So, and then we then market out to those. So there's probably going to be a lot of word of mouth and PR over there. Not too worried about the customer relationships there. I think there's going to be something important to be making to be getting the retention, which increases the asset, and there's probably going to be some sort of chunk of money that they will get as a result of the asset values of living in the community. So the building, you've got the physical building that's going to be the asset, but also the community is going to become an asset, and that's going to become increasingly valuable. Is this the right business model? I'm not really sure, but it's heading in that direction. So let's finally start wrapping it up. What are they trying to do? So they're trying to accelerate the community and the whole business model, just taking over the whole means of production, to use a Marxist term, so that they're able to design the building to fit their needs, to make it highly functional, design principles. I think that is how the business model is really going to accelerate the product, where they've got an awful lot of data about how people live and work in co-working spaces. Remember, we've already got that experience with this group over decades building a large company. And then how's it going to disrupt the existing community? Well, because what this is going to do, if it works, and $350 million is trivial in the prop tech market, really, if you look at the installed asset base, it's going to really transform the way that people live and work and own in properties. And thus, one, it's going to resolve the housing crisis, and two, it's going to start bringing down housing prices for everybody else, making it less efficient for developers to work, and thus bringing more buildings to be demolished and rebuilt according to this new model. Is it going to work? I don't know, but it seems to be a potentially a serious attack on the property market. So it's worth keeping an eye out on it over the next few years as we go along. And what I think I'd like you to take away and learn from this is that when you're putting together a business model, you really need to start thinking, okay, what is the receiverism? If I need to do a prop tech market, okay, I've got to play with all the existing property and make it more efficient. What they seem to be doing here is say, okay, forget about all the existing installed assets base, let's raise lots of money and try and do something different. And so that's a very different approach. Can you start with a clean slate and do something different? Obviously, if you've got a big name like Adam Neumann's, that really helps you put something together. So if this sounds interesting, do look me up on dennis-oakley.com. Alternatively, if there's a company or a startup that you'd like me to cover in these daily talks, just pop something in the comments or email me at dennis@dennis-oakley.com. And above all, have an amazing day.